Good morning, everybody. It's Adrian Cronje speaking, and it is 10 a.m. on Wednesday, March the 11th. And I wanted to take a moment to thank you all for investing time to hear our thoughts on market movements and the outlook. These have, of course, been highly unsettling times. And so our team wanted to over-communicate with you all and to take some of the questions that you had received in advance to share with you our views as to what's unfolding in markets. Before we get to that, I just wanted to talk about a few housekeeping items. First of all, this webinar is being recorded, and we will be sure to send a playback to all of you who have attended this call, so that if there is something that you would like to listen to in greater detail at your leisure, it'll be at your fingertips to do so. Please note that all lines are muted. We have indeed received a few questions in advance, and I'll be sure to address those towards the end of my prepared remarks. But if you would like to submit any questions, please do so. And I would encourage you to do that with your relationship manager, and we will be certain to respond to your question within 24 hours. And so the key takeaway that we would like to leave with you all this morning is as follows. First of all, the 19.4% decline in 13 trading days is notable. That has been the quickest correction that markets have experienced since data has been collected. But what we want to point out is that it is not without precedent. In other words, we have been here before. Second, and most importantly, this will take time to resolve itself, which means that investors must remain patient. The current volatility we are experiencing is a result of uncertainty, which markets disdain. But the worst thing any investor can do is to sell hastily in such environments. Investors must maintain discipline. This is a theme that our capital market forecasts of this year spelled out in great detail. And one of the key points that we would like to make is it's precisely because of moments like now that we lean so heavily on our model discipline and quantitative techniques that allow us to sift through the noise and emotion and try to act in a rational fashion. Thirdly, we would like to ensure that you know that we are not just sitting on our hands watching the situation. At the end of my prepared remarks, I will tell you about some of the things we have already done to harness the volatility that we have experienced and to give you a sense of how wide our eyes are for potential opportunities as a result of the volatility that has occurred. All that being said, I want to be clear that we are not trying to make light of a very serious health situation. Global pandemics such as the coronavirus that erupted in China are rare, but they have occurred before. Part of the reason the last few weeks have felt so unsettling has been our very legitimate visceral reaction to the fact that there is a very serious health concern underway. And of course, the noise has been deafening and extreme. And frankly, it has been compounded by concerns that authorities have been behind the curve in dealing with the virus. It's important to remind ourselves during such times that, as Dr. Hans Rosling said in his book, Factfulness, there's often no room for facts when our minds are occupied by fear. By the way, for those of you who do have time, I would encourage you to Google his TED Talk on factfulness. It's always helpful, I find, to look at that and to be reminded of how important an unemotional, data-driven approach can be to staying grounded in reality. So let's hit the first point about the fact that the volatility has been notable, but not without precedent. Let's start with some facts. February started very well for both the global stock market as well as the US stock market. February started with the MSCI All Country World Index up about 4% for the year, and the US S&P 500 up about 5%. Obviously, February ended pretty dramatically down, with global stock markets down 8% roughly on the year, as well as US stock markets. That masked a 19.4% decline in 13 trading days. So no doubt it has been extremely quick, but the point that we would like to make is that it's not been without precedent. Indeed, we've seen this before. As recently as 2015, the market dropped 11% in 3 days, and you all will recall that those concerns were around stability in China after a nearly 50% decline in 2 months of the Chinese yuan. It also occurred in 2011, when the market dropped 18% in 13 days. And you all might remember those concerns were emanating around the Eurozone debt crisis and the US debt downgrade. If you look further back, May 1962, the market dropped 16.5% in a 4-day drop around the Cuban Missile Crisis. In September 1955, the 1-day drop of 7% that we experienced yesterday did occur as news emanated from President Eisenhower's heart attack. And in June 1950, the market actually experienced a 9% 1-day drop during the onset of the Korean War. So we've seen this before. What we'd additionally like to point out is that in all these cases, the market bottomed relatively quickly and bounced back within a few months. And in saying that, we're not asking you to form the expectation that things are going to get better quickly overnight. As we said in our email yesterday, and at the outset of my remarks, this is likely to take some time to repair. But since the Second World War, not one bear market has started this way. This is a key observation in our view. All such declines typically occurred in a bull market as a pit stop to eventually higher highs, or occurred during a bear market that had already begun. So the importance of discipline, if the data can help us stay grounded. Here are some observations that we would like to make. Markets do not like uncertainty. The worst thing that any investor can do is panic. It is easy to panic in today's environment as we are confronting the potential for schools closing down and for certain sectors of our economy appearing to be at a standstill. It is totally understandable that people want to limit their activities in many cases, including not engaging socially and undertaking voluntary travel and leisure. But as it relates to the markets, we have said this often, and it bears worth repeating at the current time. Because markets do not like uncertainty, they tend to shoot first and ask questions later. Even if it's bad certainty, at least the market can find a baseline, even if it's a lower one, and begin rebuilding from that baseline. In the face of such uncertainty, every bad data point seems like Armageddon, and every good data point feels like Nirvana. Thus, the triple-digit point moves we have been seeing on the S&P 500. The worst thing any investor can do is to succumb to the emotion of the day, such as selling hastily. That would be giving in to the indiscriminate selling and fearful headlines. In our view, such a reaction is not long-term investing. Rather, it is being captive to the emotional moment. The appropriate course of action, as our relationship managers will remind you, is to let things settle, and in the meantime, reassess if the data or if our thesis has changed, and only then act accordingly after thoughtful analysis. And as you will all know, our decision-making is governed by our model discipline that we have designed, enhanced, refined, and applied over nearly 2 decades and several market cycles. Our model discipline has seen this before. During these phases, and this morning is no different, there will be violent up days and violent down days. And we acknowledge that the down days feel far worse than the up days feel good. This is a well-known behavioral phenomenon, and we feel the same way. It's going to be hard for investors to hunker down and do what needs to be done as we get through the next few days. So let's turn to our current thoughts. And we have a collection of observations about questions we often ask, that are often asked of us. Of course, on the top of most people's minds is how much of the last couple of weeks of volatility has been pure panic versus how much will have a residual effect on the US and global GDP. Our hypothesis is that given the data before us today, that there will indeed be economic effects. But it is still too early to conclude that a recession in the United States is inevitable. When we use the word recession, we are using the definition of 2 consecutive quarters of declining GDP. In a moment or two, I'll show you how our models lead us to conclude that the environment has turned from very optimistic to questionable, but that it is way too early to conclude that a recession is inevitable and that this is going to turn into a sustained bear market. That being said, patience will be key. We will experience an adjustment period in markets that will take time. It is interesting for us to see that while it is still early, the market has begun to sort through the winners and losers from the combination of the coronavirus health epidemic, which has been made worse by the oil price shock that occurred on Friday, as it became clear that the loose bindings that kept OPEC together might be falling apart. At an asset class level, the energy sector, as a result of the oil price shock, and the financial sector, as a result of interest rates collapsing, have borne the brunt of the decline. In other words, as we view the world, value stocks have underperformed growth stocks. And so our bias of emphasizing growth over value that has worked so well for us in recent years has actually provided some measure of protection to portfolios from some of the worst hit areas. What can we say about the bond market? Clearly, in February and early March, we saw a panic in the bond market unlike any other since the Second World War. And yes, that includes during the global financial crisis. The 10-year US Treasury note and 30-year US Treasury bond began February at 1.5% and 2% respectively. By early March, these respective yields had fallen as low as a previously unthinkable 0.3% for the 10-year Treasury note and 0.7% for the 30-year US Treasury bond note. As one commentator pointed out this morning, the entire US yield curve was under 1%. From a return standpoint, the returns on respective maturities and fixed income to date have far exceeded those of the global financial crisis. We would point out, importantly, that our bond positions have done what we expected them to do, a high-quality ballast to our stock exposure. The lesson we keep reminding ourselves and investors is that when it comes to fixed income investing, keep it simple. Do not succumb to the reach for yield, which often forgoes ballast properties in times like these. Of course, last week, the Federal Reserve reduced the federal funds rate by 50 basis points in response to the decline in longer-term rates resulting from fears of the impact of the coronavirus on the economy. Last month, we highlighted in our market notes that the Fed was beginning to articulate some potential concerns, and rather than waiting until their next meeting, they felt that they had to act between meetings. So the key question to us is how much of this is pure panic and how much will actually have a residual effect on US and global GDP and therefore corporate earnings in dividends. In other words, how much of a margin of safety is there for earnings and dividends, given that we have to acknowledge that the economy is likely to be weaker in the short term than many investors expected as recently as the beginning of February. At this point, as I said earlier, we do acknowledge that there will be economic effects, but it is still way too early to conclude that there will inevitably be a recession. We do not, however, rule out the possibility of 1/4 of contraction of GDP. Regardless of whether this turns out to be correct or not, in either case, we are looking at an adjustment period in the markets that will take time, and patience is key as the market repairs. We've been asked some questions about what we think about the oil price declines. Clearly, the oil price market is experiencing distress unlike it has experienced for a while. The last time the oil price convulsed to this extent was way back in 2015. Clearly, this is an OPEC-led supply shock, and the Saudis and Russians have to find some common ground, thus alleviating the supply shock component to what occurred on Friday morning. That said, we expect the industry to undergo some restructuring that did not get accomplished with the previous oil price adjustment way back in 2015. This restructuring will take time and will likely more than offset any gains to the consumer from lower gas prices. What do we think about monetary policy? And here we'd like to harken back to a theme that we have been warning about and planning for some time, which is given how low interest rates were going into this potential bout of volatility, increasingly monetary policy is likely to be impotent in providing a salve to this volatility. Over the last 10 years, every time we have experienced volatility, the Federal Reserve has been able to reassure markets with a promise of lower interest rates. Given where interest rates are today, monetary policy is likely to become increasingly impotent for situations like the last 2 weeks. For us, that means we expect the authorities to begin to lean more heavily on fiscal policy in order to take the baton to provide the necessary stimulus to the economy in the short term. And there are already signs of them taking that very seriously. Obviously, they recently passed the $8.3 billion package that was approved by Congress. There are there are proposals for a pretty dramatic and immediate payroll tax cut. And there is also talk about new employee assistance programs. This theme about fiscal policy taking over from monetary policy, in our view, is absolutely key, and we talked about it in detail in our capital market forecasts published earlier this year, and it of course has some important medium-term and long-term implications for us to capitalize on. Lastly, what do we think about a recession? And here we would like to spend just a few minutes reminding you all of how we use our models to tell us what messages capital markets are sending about the likelihood of a recession or a downturn occurring in the near future. And of course, the article that spells out this methodology in detail can be found on our website. It is called Are Recessions Red Lights Flashing? So if you type that into the search function of our website, you'll be able to pick up in great detail what I'm about to walk you through. But in a nutshell, what we lean on are 4 key capital market indicators. The messages the stock market, the bond market, the credit market, and the commodity market send about future economic activity. Because it's our view that economists and strategists actually have a pretty poor track record in being able to forecast the future economy, much as that pains me to concede being a student of economics. So let's take each one in turn. First of all, the stock market. This particular slide grounds us all in just how far we have come during this record-setting bull market. In dark blue, we have the performance of the US stock market as measured by the S&P 500, and in light blue, we have the performance of international stock markets. And there are a couple of key points to take away from the long ascent we've experienced in stock price appreciation. Firstly, the extent to which the US has dramatically outperformed international assets. It has been unprecedented. Second, and most importantly, you will see that the ascent has been relatively smooth, at least until recently. There were only 2 periods prior to the last couple of weeks where markets came close to experiencing a bear market, which investors traditionally define as a 20% contraction from peak to trough on a sustained basis. That, as I said earlier, occurred in 2011 and in late 2015 and 2016, and then of course in the 4th quarter of 2018. So the volatility today feels especially jarring in the context of the unusually low period of volatility that we have experienced over the last 10 years. And of course, the reason why this message from the stock market, that is whether it turns into a bear market or not, is a key indicator of the future, is that there has never been a recession in our history without corporate profits going into a recession. And so the stock market every day is handicapping what the current level of corporate profitability as well as the future level of corporate profitability is likely to be. And if it views that corporate profits will go into a recession, it's a fairly reliable indicator that when it turns into a bear market, that a pretty major downturn is on the way. Importantly, it is not a fail-safe measure, and that is why we don't just lean on the stock market. We keep a sharp eye on the bond market too. We've used this slide often before in our communication to highlight the importance of the slope of the yield curve. In plain English, that is the difference between short-term rates in this slide, measured as the 2-year Treasury bond, and 10-year Treasury bond, long-term rates. And what you should take away from this particular slide is how the slope of the yield curve behaves 12 to 18 months in advance of recessions, the gray bars. And what you will see is that the yield curve typically inverts, to use bond market jargon, or short-term rates become higher than long-term rates 12 to 18 months before a recession starts. And this is something that has been a component of our models in assessing the outlook for a long time, indeed for 2 decades. And so it was a little bit of a surprise to us last year when the media jumped on how quickly the yield curve was flattening. And the reason, of course, for that is the media is waking up to how powerful this is as setting a speed limit for how the Federal Reserve has calibrated monetary policy. Because the Federal Reserve too is as aware of this particular indicator as investors are, and they want to do everything in their power in order to ensure that the yield curve retains a positive slope. And the reason for that is if a yield curve is positively sloped, our banking sector is able to make profits and is therefore more likely to continue to lend, to promote economic activity, and to avoid economic downturns. So that, at least in part, was why they acted so swiftly last week. And even though long-term interest rates collapsed pretty dramatically, one thin silver lining that we see today that help us stay grounded, that help us reinforce our view that it is too early to conclude that a recession is inevitable, is that the yield curve is still retaining a positive slope. The third indicator that we use in conjunction with the stock and bond market is the message that the credit markets send. And so this is the difference in rates between high yield bonds and safe treasury bonds, or a measure of the spread or expensiveness that corporate America has to experience in order to finance itself. And the key takeaway, as our article highlights, is that over the very long run, that spread should be around 500 basis points. And what you'll observe as you look at this relationship going way back in time is that when this spread starts to approach 500 basis points and actually breaches that yardstick on a sustained basis, that is an additional confirming indicator that the credit market is expecting a rise in defaults because an economic downturn is on its way. And what this slide will show you is that until recently, credit spreads have remained pretty tight. And so access to financing that corporate America needed was easy and cheap to get. And even on a diversified basis, you'll see in blue that despite the volatility in the last 2 weeks, that level is still at around 500 basis points. Most of the distress in credit markets self-evidently have related to the energy sector in dark blue, and that speaks to the credit market discounting the distress that a dramatically declining oil price shock are having on energy producers. The last indicator is the commodity market. And as we have pointed out, this is an important market for investors to keep an eye on, because it really does give a real-time check on the health of the global economy. As I said at the outset, there has never been a recession in the United States without corporate profits going into a recession. While speaking to the continued dominance and might of the US economy on the global stage, there has never been a global recession without the US going into recession first. And what we want to be careful about is to recognize that over the last 10 years, that dynamic might have changed. In the onset of the 2008-2009 great financial crisis, the United States still produced the majority of global GDP. 10 years later, today, it still continues to be the dominant contributor to global GDP, but in aggregate, China and other countries in the emerging world produce more global GDP than the US does. And because that area of the world is so intensive in the production and consumption of commodity markets, the way in which commodity prices act every day does give a real-time temperature check on the distress the rest of the world is feeling, and a read on whether there is the potential for the United States to import a recession from abroad for the first time. And so we've highlighted in this chart in light blue the Bloomberg Industrial Metals Index. In that index, commodities such as copper, nickel, iron ore, commodities that are used in the production and consumption of things, do give a real-time check on how well the Chinese and other parts of the emerging world are performing. We've contrasted that in dark blue to the Bloomberg Industrial, in light blue, the Bloomberg Precious Metal Index, and in dark blue, the Bloomberg Industrial Metals Index. And yes, of course, the gold price, as reflected by the light blue line, has rallied sharply, as it always does during distress. What has been interesting for us to note, at least prior to the oil price shock on Friday, is that this indicator was hanging in there. The copper price, or Dr. Copper as it's been known as its forecasting ability on the global economy, had corrected, but only around 10 to 12%. And it had been interesting to us that in recent days, the emerging market stock and bond indexes were beginning to outperform the rest of the world. Perhaps, and this is not conclusive evidence, but perhaps that was the market signaling that the news around the coronavirus had stopped getting worse. So in sum, as the next slide shows, today these capital market indicators are flashing yellow across the board. Importantly, whether we look at future corporate profitability in the stock market or future interest rates and Fed policy through the bond market, through optimism in the corporate sector, the credit market, or indeed the international economy, especially China, the indicators for us are signaling yellow. A year ago, both the stock market and credit market were sending unambiguously positive signals, and that has been the reason for why we had maintained successfully such a constructive stance for the last year. It is, importantly, too early for us to conclude that a recession is inevitable. And I'd like to end off my remarks with just painting a picture of some of the other data that markets and the media have been quick to push to the background. On Friday morning, we received yet another very positive payrolls report. The labor market in the United States has entered this period of distress in its strongest position in over 50 years. The unemployment rate has been declining in dark blue to levels not seen since the 1950s and 1960s. And in light blue, very encouragingly, average hourly earnings of all employees had steadily started to increase. And that is important because if we can continue to maintain very high levels of employment and employees are rewarded well, that will feed into consumer confidence continuing to hang in there despite some of the news and the hype that the media is portraying about these two very serious situations. Consumer spending is still over 60% of GDP, and I think it's worth reminding everybody of the momentum behind the labor market, even as concerns have arisen around the global pandemic, potentially that coronavirus might bring, and the oil price shock relating to OPEC's decisions last Friday. I will also point out that the data as it relates to the housing market in the US has continued to remain very robust. And obviously that speaks to folks' ability to refinance mortgages and so forth on lower interest rates. And so unemployment and housing are such a key component and a multiplier effect on our economy. One thin silver lining is it entered this period of volatility with a lot of momentum. So in conclusion, as I said at the outset, we have been here before. It is very difficult, we acknowledge, to stay grounded in a data-driven, unemotional approach. I just wanted to end off my remarks as I remind you of what our 2020 capital markets forecast looks like. That can be downloaded from our website at your leisure. But we're not just sitting on our hands as a team, watching markets gyrate and communicating with clients. We have used the last 6 or 7 days for our taxable clients to aggressively tax loss harvest opportunities so that we can build up losses to protect gains in the future and keep an eye on efficient after-tax returns. The investment team, as it always does, is watching daily for potential opportunities in certain asset classes that may be presenting themselves. One only has to look at the bloodbath in the energy complex, and in particular MLPs, to look at how far prices have fallen and the potential value that they offer in today's environment. The financial sector is another example of an area in markets that has experienced severe distress because of concerns about low interest rates far into the future. Currently, the bond market is expecting the Federal Reserve to cut interest rates another 3 times, perhaps even handicapping a full further 1% decline, all the way to just above 0 before the end of the year. Of course, as I said at the outset, we question just how effective that would be, and we would see greater efforts as fiscal policy to be more effective and a more encouraging policy response to what has unfolded. So I hope that has been helpful to share our thoughts with you. I'm going to address 2 questions that were sent to me in advance. The first question came about some of the asset classes in which we see opportunities. I hope I've already addressed that by talking about the energy sector and financials in particular. Value stocks have dramatically underperformed growth stocks. That is an emphasis that has worked in our favor. Perhaps this is going to be the catalyst for value to begin to reassert itself after so much fear has gripped these areas of the markets. As always, our decisions will be governed by our models. One does not want to buy an asset class at very cheap levels before it becomes even cheaper. That is why our discipline complements our read on value with momentum. And so we will continue to keep you all updated on some of the opportunities that we see developing on this arena. The second question that we received in advance related to how much this has been markets reacting to the effect of China on the integrated global supply chain. And there is no doubt that the coronavirus epidemic has been somewhat of a black mark for the Chinese brand in its ability to manage its economy. And that's an important medium to long-term implication from all of this that is going to take some time to play out. But the point that we would make, and we'll send some of the details to you all in response to this question, is actually the tariff war that erupted in 2018 had already forced markets to begin to think about where China lies in the integrated global supply chain. And so many businesses had already taken steps to remove their over-reliance on China as a cheap source of labor in the production of the goods that they seek to sell. One interesting implication that we're thinking a lot about is not just what positive effect that has on the US economy, but what positive effect that has on some of the economies around China in Asia, such as the Philippines and Vietnam, where potential opportunities may lie as the world begins to think more carefully about an over-reliance of China in their integrated supply chain. We're sure that some of these comments probably promoted more questions. We will be sure to give you our answers to those within 24 hours. We hope that you will continue to lean heavily on your relationship manager if there's anything we can do to help. So I'll end off by thanking you very much for your time and for the trust that you place in our team. We are working very hard every day to ensure that your financial goals will be met over time. Thank you.